Welcome to the deep dive. Today, we're cutting through the noise, really getting to the core of company financials. Specifically, we're looking at those often ignored notes to financial statements.
That's right.
We're going to unpack why these aren't just, legal boilerplate, but actually your secret weapon for true insight. Think of us as your guides, maybe, helping you navigate the sometimes murky waters of corporate reporting. Okay, let's unpack this.
Yeah.
Because what we're diving into today is, I think, absolutely fascinating. It really holds the key to truly understanding a company's health.
And thank you for joining us. What's fascinating here is that we're looking beyond just the surface numbers. So many people, they glance at a company's financial statements, the balance sheet, income statement, cash flow, and they think, okay, I've got the full picture.
Right, they see the big numbers.
Exactly. But often, the real story, the underlying structure that guides major financial decisions, it's hidden in plain sight. It's in these seemingly dry, often quite lengthy, notes to financial statements. These notes reveal crucial insights that you simply won't find anywhere else.
Absolutely. So today, our deep dive is all about these crucial, often underestimated notes to financial statements. For anyone looking to truly understand a company's financial health, maybe you're an investor trying to pick stocks, or a business professional analyzing a potential partner, maybe you're just incredibly curious about how the financial world really ticks, these notes are your secret weapon. Our mission today is to transform what can feel like dense financial jargon into clear, digestible knowledge. We'll focus on what's most important in these notes and, crucially, why it matters directly to you. So let's kick things off with what's arguably the cornerstone of these notes: the summary of significant accounting policies. Now, you might think of notes as just an appendix, right? Something tacked on at the end, but that's really not the case here.
Not at all.
U.S. GAAP, generally accepted accounting principles, actually requires that a description of all significant policies be included as an integral part of the financial statements. Often, this summary is the very first or second note you'll find. So I have to ask, why is this section positioned so prominently? What foundation does it lay? For me, it feels like finding the instruction manual for how a company tracks and reports its money.
That's a perfect analogy. It really is. The U.S. GAAP requirement for this summary isn't just about disclosure for disclosure's sake. It's about setting the stage for every single number that follows. It's positioned so prominently because it provides the essential rules of the game for that specific company's financial reporting.
The rules of the game. I like that.
Yeah, imagine trying to understand, say, a chess match. Without knowing how each piece moves, you'd be completely lost.
Totally lost.
This summary tells you how the company records its transactions, how it values its assets, how it recognizes revenues and expenses. It lays it all out. And it's also vital to note that policies presented here shouldn't be duplicated in other notes. That's key for clarity.
Oh, interesting. So no repetition.
Right. It avoids redundancy, keeps the summary focused on the core policies, not, specific dollar amounts or transaction details. It truly is the constitution, maybe, of a company's financial reporting.
So this is the how-to guide for their numbers, their specific rules. But what specific information, what kind of critical details will you actually find within this summary?
Well, you'll find a wealth of detail, actually. First, it includes the measurement bases used in preparing the financial statements. This tells you how assets and liabilities are valued on the balance sheet. For instance, is inventory valued at its historical cost? What the company originally paid for it?
Okay.
Or is it at its current market value, which, well, it could be lower if prices have fallen or if there's a concern about obsolescence.
Right, like tech goods becoming outdated.
Exactly. Understanding this gives you immediate insight into the, let's say, conservatism or perhaps aggressiveness of a company's asset valuation.
Yeah.
A company valuing assets at historical cost when market values have actually plummeted might look healthier on paper than it truly is.
Ah, okay. That makes sense.
Whereas one marking down to market value is being, well, more transparent about its current reality.
That's huge. Just knowing if an asset is listed at what they paid for it years ago versus what it's truly worth now could entirely change your perception of its financial strength. Definitely. What else is in there under specific accounting principles and methods?
Right. This is where the real granular detail lives and where understanding the nuances can really set you apart. For example, the basis of consolidation.
Consolidation. Okay.
So when a parent company controls other entities, their financial statements are often combined or consolidated. This note explains how they do that. For instance, if they fully consolidate all subsidiaries, or maybe if some are accounted for differently because of, varying ownership structures or different levels of operational control,
Mm-hmm.
It's crucial because it tells you whether the financial statements you're looking at represent just the core parent company or the full scope of its operations, including all its subsidiaries. Without this, you might be looking at only a fraction of the true business.
That basis of consolidation is huge, especially for a giant conglomerate. But I've seen situations or heard about them where companies strategically don't consolidate certain entities.
Yeah.
What are the implications of that? And, how does a savvy investor spot if they're maybe intentionally hiding parts of their operation or just structuring it legally in a specific way?
That's a fantastic question, and it speaks directly to the deeper insights these notes offer, really.
Okay.
Legally, companies must consolidate entities they control. Now, control is generally defined by ownership of more than 50% of voting stock, but it's not always that simple. You can have complex structures like variable interest entities, or VIEs, where control isn't tied neatly to voting interests. Determining if consolidation is required there can be, well, tricky. When an entity isn't consolidated, its assets, liabilities, revenues, expenses, they won't appear directly on the parent company's main financial statements.
So they're off the main books, kinda.
Kind of. Instead, the parent might just record its investment in that entity, or maybe its share of the entity's profits or losses, as just a single line item. So for a savvy investor, this means you absolutely need to look beyond the main statements and into these notes to understand the full universe of operations and, importantly, potential liabilities. If a company is heavily reliant on these unconsolidated entities, you might be missing significant off-balance sheet risks, or just not getting a true picture of their overall leverage. These notes become vital for piecing together the full economic reality.
That makes perfect sense. It's like seeing the whole iceberg, not just the tip.
Yeah.
Okay, so moving from structure to operations. Once a company sets its valuation rules and decides what to consolidate, we then need to think about how they account for the wear and tear on their physical assets. Depreciation methods, they can significantly alter the profit picture, can't they?
Well, they absolutely can.
Yes.
The depreciation method section describes how a company systematically allocates the costs of its tangible assets, things like machinery, buildings, vehicles, over their estimated useful lives.
Right.
And there are different methods. You've got straight line, which spreads the cost evenly over the asset's life, simple enough.
Right.
Or you have accelerated methods, which recognize more depreciation expense in the early years and less in the later years.
Why would they do that? Tax reasons.
Sometimes tax motivations play a role, but it can also be argued it better reflects the asset's usage pattern or loss of value. The point is, the choice of method significantly impacts reported profits and the net book value of assets on the balance sheet. For example, a company using an accelerated method will show lower profits in earlier years compared to one using straight line, even if their operational performance is identical.
Wow. Okay.
So for you, the listener, this means if you're comparing two companies in the same industry, you really need to normalize for these differences.
Right.
You have to understand their depreciation policies to get a true apples-to-apples comparison of their operating profitability. It's a key example of how an accounting policy choice, not just operational efficiency, can shape the reported numbers.
I hadn't quite considered that angle. Different methods, different profit picture, even with the same underlying business. Okay. And then there's amortization of intangibles. Most listeners probably know what intangibles are: patents, trademarks, goodwill, maybe. But the crucial point here is how a company chooses to amortize them, right?
Precisely. So just as tangible assets like machinery depreciate, these non-physical assets, your patents, your brand's goodwill, they are amortized, spread out over time. But here's a crucial distinction for you. The useful life of an intangible can be incredibly subjective.
Ah, right. How long is a brand valuable?
Exactly. Is a software patent truly valuable for 10 years? Or could it become obsolete next year with some breakthrough in AI? This note reveals management's judgment on how long these critical, often fragile assets will continue to generate value for the company. An aggressive amortization period, stretching it out, might inflate earnings in the short term by deferring expense recognition.
We think things look better now.
Right. While a more conservative, shorter period might signal management's cautious outlook, maybe lowering current profits but being more realistic. It's a key signal of management's long-term optimism, or perhaps conservatism, about these sometimes fragile assets.
Okay, so essentially the same idea as depreciation, but for things you can't touch, and with an added layer of management judgment baked in. Makes sense. And inventory pricing. That sounds like it could be a big deal for, say, a retail company or a manufacturer.
Oh, it is a very big deal, particularly in industries with high inventory turnover or volatile input costs. Think commodities or electronics. Inventory pricing methods like FIFO, first in, first out, LIFO, last in, first out, or weighted average, can significantly impact a company's reported cost of goods sold, COGS, and consequently its net income and the inventory value sitting on the balance sheet.
FIFO, LIFO, I remember those from accounting class.
Right. And the deep insight here is this. In times of rising prices, a company using LIFO might actually appear less profitable on paper because their COGS reflects the latest higher costs.
Okay, so higher cost, lower profit.
On paper, yes. But, and this is key, they're likely paying less in taxes because their reported income is lower, so they might be retaining more cash.
Ah, the tax angle. Interesting.
Conversely, FIFO, in rising price environments, can inflate reported earnings, making profits look better but potentially leading to higher tax bills. An investor must normalize this, understand which method is being used to truly compare companies. Otherwise, you might dismiss a cash-rich, tax-efficient business just because of its accounting choice for inventory. It's a classic example of how reported profit doesn't always align directly with cash flow, and understanding the policy is absolutely key to unlocking that distinction.
That's a profound impact just from how you count your widgets. Really drives home the point. Now, one that always gets me is the use of estimates. Because aren't numbers supposed to be, well, exact, solid?
This is such a crucial point and really underpins so much of financial reporting. The use of estimates section explicitly explains that financial statements aren't just hard facts and figures. They involve significant management judgments and assumptions.
Like guessing, almost.
Well, informed guessing, hopefully. For example, a company has to estimate how much of its accounts receivable, the money owed by customers, will likely become bad debt and never be collected. Or they have to estimate the useful life of a piece of equipment before it needs significant repair or replacement. How long will that machine really last?
Right.
These estimates directly impact reported assets, liabilities, revenues, and expenses. The key takeaway for you is that these estimates introduce a degree of variability, sometimes significant variability, into the financial results. Actual outcomes could differ, sometimes materially, from management's initial best guesses.
So management's optimism or pessimism directly colors the numbers.
Precisely. An overly optimistic management team, for instance, might make estimates that flatter current earnings, maybe assuming a very low bad debt rate or a very long useful life for assets. But this can create a potential for future downward adjustments if those estimates prove too rosy. It's where management's perspective truly shapes the financial narrative being presented.
So, if a company is very optimistic in its estimates, its profits might look better in the short term, but that could unravel later if reality bites.
That raises an interesting point. What about something that sounds as simple, almost trivial, as fiscal year definition? Does that really need explaining?
It sounds simple, absolutely, and it often is just a date. But knowing the company's fiscal year definition when its financial year begins and ends is absolutely fundamental for accurately comparing its performance over time or against other companies.
How so?
Well, most companies use a calendar year ending December 31st. But many, especially in retail, for example, use a fiscal year that ends at a different point. Maybe January 31st, after the holiday shopping season is completely wrapped up and returns are processed.
To match their business cycle.
Exactly. If you don't know this basic piece of information, your comparisons could be entirely off. You might compare a retailer's post-holiday quarter against another company's pre-holiday quarter and draw completely wrong conclusions about their performance or trends relative to peers. Right, you can't compare apples to oranges, or in this case, a January 31st year-end to a December 31st one. Good point. And finally, in the summary section, what about special revenue recognition issues? That sounds like a potential rabbit hole.
It definitely can be complex. This disclosure highlights the intricacies in recognizing revenue for certain types of operations that aren't just simple, cash and carry sales.
Like what kind of operations?
Well, think about long-term construction contracts. A company building a skyscraper over 5 years. Do they recognize revenue evenly each year based on the percentage of completion? Or do they wait and recognize it all only once the contract is fully completed?
Huge difference in reported revenue year to year.
Massive difference. The chosen method can drastically alter the reported revenue stream in any given year. Or think about franchising operations. Revenue recognition depends on when specific services are rendered or fees are actually earned, not just when a franchise agreement is signed. And leasing operations have their own very specific, often complex rules about when revenue from leases can be put on the books. These special rules impact when revenue is recorded, which directly affects a company's reported profitability in any given period. So for the listener, this means understanding if a company's revenue is steady and predictable, like a subscription service, or if it's tied to complex long-term projects with lumpy recognition. That lumpiness can introduce greater volatility into their reported earnings. It's not as simple as just selling a product and recording the sale, and this note explains those crucial intricacies.
Wow, that's a lot of foundational information just in this first or maybe second note. It really makes you realize how many decisions, how many judgment calls go into those numbers we often take for granted on the main statements. So if we connect this to the bigger picture, what's the real so what for understanding these significant accounting policies? Why should we care so much?
Understanding these policies is paramount, really, because it helps you compare companies much more effectively, even across different industries, or certainly within the same industry. It highlights the choices management makes in presenting its financial picture. Two companies in the exact same business might look very different on paper simply because they've chosen different, but equally acceptable under GAAP accounting policies.
So you can't just compare profit margins directly without knowing the rules they used.
Exactly. Knowing these policies allows you to sort of normalize those differences and make much more informed, much more meaningful comparisons. It's the key to truly understanding a company's financial DNA, how they measure themselves. Now, it's equally important, I think, to understand what the summary of significant accounting policies doesn't include.
Yeah.
It's not meant to be exhaustive about everything.
Like what's left out?
For instance, it would not contain the composition and detailed dollar amounts of account balances.
Hmm?
You won't find a line-by-line list of individual customer receivables here. That kind of granular data belongs in other, more specific notes.
Okay, so no raw data dump.
Correct. Similarly, details relating to changes in accounting principles are crucial, absolutely, but they are disclosed in separate dedicated notes, precisely because they warrant their own detailed explanation of the change and its impact.
Makes sense. Give it its own space.
And the dates of maturity and amounts of long-term debt are also found elsewhere, typically in notes specifically dedicated to debt obligations. Again, for a clear reason, it's specific financial detail about borrowings, not an overarching policy.
Got it.
And finally, the yearly computation of depreciation, depletion, and amortization is excluded from this summary, while the method used, straight line, accelerated, etc., is stated here in the summary.
The policy, right.
The actual numbers, the dollar amount of depreciation taken in a given year, are found elsewhere in the financial statements or potentially in other notes related to assets. It's, like we said, it's the constitution of a country's finances, not the daily news headlines. It's about the overarching rules, not the daily transactions or the specific financial totals for the period.
That's a great distinction. It really helps keep this foundational note focused and prevents it from becoming just an overwhelming data dump right at the start. So the summary of significant accounting policies acts like the company's financial DNA. It tells us how they're built, how they measure things. But once we understand their internal rules, where do we go to find the real story of their daily operations, their successes, their challenges, the specific numbers behind the policies? That's where the rest of the notes come into play. And trust me, as you said, this is where the plot often thickens.
Indeed. The remaining notes to the financial statements are where all other information relevant to decision makers resides. Think of investors, creditors, analysts, other stakeholders. These notes are crucial because they're used to disclose important facts not presented in either the main body of the financial statements, the balance sheet, income statement, cash flow, or in that summary of significant accounting policies we just discussed. These are the details that truly flesh out the picture, adding crucial context and depth to the raw numbers you see up front.
So these are the appendices that really matter, where the detail lives. Can you walk us through some of the most common and vital examples of what you'd find in these remaining notes and maybe touch on why they're so important to us, the people trying to understand the company?
Absolutely. One key area is material information regarding inventory, property, plant, and equipment, PPE, and other significant asset liability balances that require specific disclosures.
Okay, the big balance sheet items.
Exactly. For inventory, this means not just the total dollar amount you see on the balance sheet, but details about its composition. Is it raw materials waiting to be used? Is it work in progress on the factory floor? Or is it finished goods ready to sell?
That distinction matters.
It does. It tells you about potential production bottlenecks or sales slowdowns. The notes will also reiterate the valuation methods used, maybe providing more specifics than the summary. And crucially, they'll detail any write-downs due to obsolescence or damage. The critical takeaway here, this helps you assess the quality of a company's inventory and the risk of it becoming outdated or unsellable. A large write-down can indicate poor inventory management or maybe a sudden shift in market demand, which directly impacts future profitability.
So a red flag if inventory quality is dropping.
Could be. For PPE property, plant, and equipment, you'll find details on major additions, are they investing heavily, or disposals, are they selling off assets.
Yeah.
You'll see accumulated depreciation totals, and importantly, details on any potential impairments, meaning an asset might not be worth what it's carried at. This provides crucial context for understanding a company's investment strategy. Are they expanding, modernizing, maybe shrinking, or selling off assets to generate cash? It also tells you about the health and age of their core operational assets, which speaks volumes about their future capacity and potential maintenance costs.
Gives you a feel for their physical operations.
Right. And generally, any other asset or liability balance that's particularly large or complex will likely have its own dedicated note explaining its nature, terms, and any specific risks associated with it. It adds that layer of transparency beyond just the line item.
That's a lot more than just a single number on the balance sheet, for sure. It paints a much clearer picture of what the company actually owns and how it's managing those assets. What about the financing side of things, like changes in stockholders' equity?
Ah, yes. Changes in stockholders' equity. This is vital for understanding a company's ownership structure and how profits are being retained or distributed back to shareholders. This note breaks down the components. You'll see capital stock, the actual shares issued and outstanding. You'll see paid-in capital, that's the money shareholders paid above the nominal or par value of the shares. Then there's retained earnings. Crucially, this is the accumulated profit that the company has kept over its entire history, rather than paying out as dividends. It's the engine of reinvestment.
Where their accumulated wealth sits, kind of?
In a way, yes. You'll also see treasury stock. These are shares the company's bought back from the open market, and details on stock dividends, stock splits, and other capital changes. The significance for you is, this note shows you exactly how a company funds itself and how it's managing its capital. Are they issuing new shares, which could potentially dilute existing shareholders?
Right, more slices of the same pie.
Or are they buying back shares, which can signal confidence and return value by reducing the share count? Are they holding on to their earnings for reinvestment and future growth? It's fundamental to understanding their capital allocation strategy and how they're managing shareholder value over time.
So I can see if they're issuing new shares, buying back old ones, or holding on to their earnings. That's absolutely fundamental to understanding their capital strategy. Makes sense. What about marketable securities? Companies holding stocks or bonds of other companies.
Good question. You'll also find required marketable securities disclosure in the notes. This typically includes the carrying value, what the securities are recorded at on the company's books. And critically, it includes gross unrealized gains and losses. These are the potential profits or losses if the securities were sold today at the balance sheet date, even if the company hasn't actually sold them yet.
So paper gains or losses.
Exactly, paper gains or losses. What this reveals is the company's exposure to market risk through its investment portfolio, and the potential impact these market fluctuations could have on future earnings if the company were to sell those securities, or if accounting rules require them to market through earnings. For instance, if a company holds a large portfolio of marketable securities, and there's a significant unrealized loss reported in the notes, it signals a potential future hit to earnings if they have to sell those securities, or perhaps if an impairment needs to be recognized later.
Okay, that helps me understand their exposure to market volatility separate from their core operations. And on the topic of valuation, what about fair value estimates? When do those come into play?
Fair value estimates are disclosed when and why fair value, essentially, current market value, is used instead of historical cost. This is especially common for certain financial instruments like derivatives, or maybe some types of investments that don't have readily available, easily quoted market prices.
Like private equity investments, perhaps?
Could be, or complex derivatives. This gives you a critical lens to assess, a more current valuation than historical cost provides. While historical cost is objective, it's what they paid fair value, even though it involves estimates sometimes, offers a more up-to-date snapshot of what certain assets or liabilities are actually worth in today's market. This can be particularly relevant for financial companies, obviously, or those with complex investment portfolios. It helps you understand the impact of current market conditions on their reported values, which historical cost wouldn't show.
Okay, so a more real-time view, which can be very different from what they originally paid, especially in volatile markets. Now let's talk about things that haven't happened yet, but might. Contingency losses, lawsuits, things like that.
Precisely. Contingency losses cover potential future losses from uncertain events. Think ongoing lawsuits, potential environmental cleanups required by regulators, product warranty claims that might arise. The disclosure requirements here are quite specific under GAAP. If a loss is deemed probable, meaning it's likely to occur, and its amount can be reasonably estimable, then it's actually recorded as a liability on the balance sheet and an expense on the income statement.
So it hits the books if it's likely and you can guess the amount.
Right. But if the loss is only reasonably possible, meaning it's more than remote but less than probable, or if it's probable but you can't reasonably estimate the amount, then it's disclosed in the notes without being recorded as a liability yet.
So it's flagged in the notes but not impacting the main numbers yet.
Exactly. The critical takeaway. This isn't just about potential problems in the abstract. It's management's official warning flag about potential future financial landmines. An unrecorded but reasonably possible lawsuit, if it materializes with a large settlement, could potentially wipe out a quarter's profits, directly impacting your investment's future value. It's really where the financial health of today meets the potential crisis of tomorrow, and it absolutely demands your attention as a reader of the financials.
So it's a crucial warning flag that something bad might happen and cost them significant money down the road. What about the flip side contingency gains? Potential good news.
Good question. For contingency gains, potential future gains, companies must exercise significant caution. GAAP is much more conservative here. The guidance stresses that care should be exercised to avoid misleading implications as to the likelihood of realization. Generally, these are only disclosed, if at all, if they are considered highly probable or virtually certain of occurring, and their amount is estimable.
Much higher bar than for losses.
Much higher. Why this matters. Companies don't want to overpromise future income that might not materialize. That could seriously mislead investors and damage credibility. Therefore, the reporting is far more conservative for potential gains than for potential losses, ensuring that any good news disclosed is almost a certainty.
Okay, that makes sense. Don't count your chickens before they hatch, especially in official reports. What about contractual obligations? That sounds like a pretty broad category.
It is quite broad. Contractual obligations go beyond just standard debt like bonds payable or notes payable, although those are included. This note details any significant agreements that commit the company to substantial future payments or performance. And importantly, it also details any restrictions on specific assets or liabilities that arise from these contracts.
Restrictions? Like what?
For instance, a loan agreement might restrict a company from selling a particular key asset that serves as collateral. Or, very commonly, loan agreements require companies to maintain certain financial ratios, like a minimum current ratio or a maximum debt-to-equity ratio. These are called covenants.
Loan covenants. I've heard of those.
Exactly. Failure to meet these covenants could trigger a default on the loan, even if the company is still making its payments. That could have severe consequences. What this reveals is the commitments the company has made and potential constraints on its future operations or financial flexibility. These are sometimes called the hidden handcuffs that can limit management's strategic choices, and you absolutely need to be aware of them.
Hidden handcuffs, that's a good way to put it. And then something like a pension plan description. Is that still relevant for many companies these days, with 401ks being more common?
It's less common for new employees, certainly, as most companies have shifted to defined contribution plans like 401ks. However, many established companies still have legacy-defined benefit pension plans for older or retired workers. For these companies, the pension plan description note provides absolutely crucial details. It covers the plan's funding status. Does it have enough assets set aside right now to cover its estimated future obligations to retirees?
The funded status, right.
Yes. It also details the actuarial assumptions used to estimate those future obligations. These are critical things, like the expected rate of return on the plan's assets, the discount rate used to value future liabilities, and assumptions about the life expectancy of retirees and future salary increases.
Oh, lots of estimates again.
Huge estimates, and small changes can have big impacts. The note also outlines the overall obligations themselves. The significance for you is these pension plans can represent massive future liabilities that might not be fully reflected directly on the balance sheet in a simple way. If a plan is significantly underfunded, it could pose a major financial risk, potentially demanding large cash injections from the company in the future. That's cash that could otherwise be used for growth investments or dividends. It can be a real drain.
Wow, okay. So even if it's a legacy thing, it could be a huge hidden liability lurking in the notes. What about segment reporting? Is that mainly for the big, diversified companies?
Yes, exactly. If a company operates in multiple distinct business segments, say different product lines or industries, or in multiple distinct geographic areas, the segment reporting note breaks down key financial data like revenue, profit or loss, and assets for each of those segments.
So you can see how each part of the business is doing individually.
Precisely. This provides crucial context for understanding the true drivers of the company's overall growth, or identifying potential areas of concern. For example, a diversified conglomerate might be reporting decent overall profit growth. But this note could reveal that one segment, maybe their legacy business, is actually losing money and being propped up by a newer, high-growth segment.
That's vital information.
It is. It allows you to identify the true engines of value creation within the company and pinpoint potential problem areas that might be masked by the aggregated company-wide numbers. It's essential for assessing the quality and sustainability of the company's overall earnings.
So if a company is doing well overall, I can dig into this note and see if it's just one division carrying all the weight or if all parts are contributing healthily. That's incredibly insightful. And what are subsequent events? Events after what?
Subsequent events are critical for getting the most up-to-date picture possible from audited financials. These are significant events that occur after the balance sheet date. So after the end of the period, the main financial statements cover, say, December 31st.
Okay, after the reporting period ends.
But before the financial statements are actually finalized and issued to the public, which might be weeks or even months later.
So things that happened between the end of the year and when the report comes out.
Exactly. Examples would include major mergers or acquisitions announced in January, a significant asset sale finalized in February, maybe the settlement of a major lawsuit, or even a natural disaster like a factory fire that occurs after year-end but before the report is published. The real takeaway here is this provides critical, very recent context for the financial picture you're seeing. It informs you about significant things that have happened since the official numbers were crunched, but are highly relevant to the company's current state and future prospects. It's the closest thing to real-time updates you'll typically get in audited financials.
That's a crucial update for anyone making decisions based on those statements. You absolutely need to know if something big just happened that changes the outlook. And finally, in this section, what about changes in accounting principles or new accounting standards? You mentioned policies earlier, but this is about changes.
Right. Accounting rules,
Yep.
GAAP, are not static. They evolve. Standard-setting bodies issue updates. So this note, changes in accounting principles or implementation of new accounting standards updates, details any changes a company has voluntarily made to its accounting principles.
Like switching inventory methods, maybe?
Possibly, although switching major policies like inventory methods is less common without a good reason. More often, it might be a change in how they estimate something or adopting a new industry practice. Or, very commonly, it details the impact of adopting new accounting standards updates that are required by GAAP. There have been major updates to revenue recognition and lease accounting in recent years, for instance. This note explains the change, why it was made or required, and crucially, its impact on the financial statements. What this reveals is it helps you understand comparability issues between different reporting periods. If a company changed its revenue recognition method due to a new standard, for example, its current year's reported revenue might not be directly comparable to last year's under the old rules. This note explains why and often quantifies the impact, sometimes providing restated figures for prior periods to help comparison. Auditors pay very close attention to this to ensure transparency and proper application of the changes. What's fascinating here really is that these remaining notes are where the auditor and the regulator, through GAAP requirements, shine a light on so many crucial facts, ensuring transparency for anyone making decisions about the entity, which really raises an important question. What happens when these estimates and uncertainties we've talked about come into play, especially when there's potential for significant change in the near future? How is that handled?
That's a perfect segue, actually, because our next segment dives deep into exactly that, navigating risks and uncertainties. U.S. GAAP requires specific disclosures about these vulnerabilities, providing insight into a company's potential weak spots. So, what does this all mean for us? Why is disclosing these risks and uncertainties so important for your understanding of a company's true health and stability?
Well, this section directly addresses the inherent uncertainties that exist in any business, and consequently in financial reporting. It's fundamentally about providing transparency. Transparency regarding what could potentially go wrong or what isn't fully certain yet. It's essentially management's way of saying, look, here's what we know, here's what involves significant estimation, here's what could change, and importantly, here's what the potential financial impact of that change could be. This allows you, the user of the financial statements, to better gauge the potential volatility and the resilience of the company.
That's a crucial layer of honesty, or required honesty, I suppose. So let's break down the specific areas of disclosure here, starting with the nature of operations. What does that cover?
The nature of operations section describes exactly what the entity does. Pretty fundamental. It outlines its major products or services and its principal markets, including the geographical locations of those markets. If the entity operates multiple distinct businesses, maybe a diversified conglomerate with divisions in aerospace, consumer goods, and healthcare, the disclosure should also describe the relative importance of each business to the overall entity. Is one division driving 80% of the profit?
Okay, so what they do, where they do it, and what parts matter most.
Exactly. The significance for you is this gives you a clear, foundational picture of the company's core business model and its market exposure. You'll know if it's a, say, single product company operating in a very specific niche market, which might make it potentially vulnerable to shifts just in that niche,
Right, less diversified.
or if it's a broad, diversified entity with operations across the globe, which might offer more stability through that diversification. It sets the stage for understanding their specific risks.
So it's basically their elevator pitch for what they are and where they operate. Next, we have use of estimates in the preparation of financial statements. You mentioned this earlier in the summary of policies, but how is it detailed differently here in the risks section?
Right, it's revisited here, often with a very standard, almost boilerplate statement.
Uh,
But it's important boilerplate. It explicitly says something like, the preparation of financial statements in conformity with generally accepted accounting principles, GAAP, requires management to make estimates and assumptions that affect the reported amounts of assets and liabilities, the disclosure of contingent assets and liabilities at the date of the financial statements, and the reported amounts of revenues and expenses during the reporting period.
okay, standard stuff.
Yes, but the crucial caveat, the line you must always remember, is the one that follows. Actual results could differ from those estimates.
There it is again.
Yes. The real takeaway here is, this isn't just legal protection language. It's a fundamental disclaimer reminding you that financial statements are not crystal balls predicting the future with certainty. They are based on management's best judgments and informed guesses at a specific point in time, and those guesses are inherently uncertain, especially about the future. It mentally prepares you for the possibility that future adjustments, or just changes in circumstances, could lead to actual results that vary, perhaps significantly, from what was initially reported. This variation could impact future earnings and asset values.
That's really powerful when you think about it. It's a built-in reminder baked into the standards not to take these numbers as absolute immutable truth. So, building on that acknowledgement of estimation, what about certain significant estimates? Where does this section get more specific about potential problems?
This is where it gets particularly insightful, I think, and where a keen eye reading the notes can spot potential future volatility or areas needing closer scrutiny. The rule is, when an estimate used in the financials is considered reasonably possible to change in the near term, and near term is typically understood to mean within the next year.
Okay, so within 12 months.
Right. And the effect of that potential change is expected to be material, meaning significant enough that it could influence a reasonable investor's decision, maybe affecting profits by 5% or 10%, or a similar hit to assets.
A noticeable impact.
Yes, a noticeable impact.
Yeah.
If both those conditions are met, reasonably possible change soon, material effect then management must disclose an estimate of the effect of that potential change. This is about quantifying the potential impact, giving you a sense of the scale of the uncertainty related to that specific estimate. It's not just saying we estimate, it's saying we estimate, and if we're off by a certain amount, here's roughly how much it could affect our results.
Wow, so it's not just acknowledging we estimate, but actually saying, here's what might happen financially if our estimate turns out to be wrong in the near future, and here's a ballpark figure for how much it might affect us. That's specific. Can you give us some concrete examples of these particularly sensitive estimates, the ones that often trigger this disclosure, and maybe illustrate why they carry such significant risk?
Certainly. These are often the areas where management's judgment has the biggest potential swing, meaning future reported results could look very different depending on how things play out. For instance, inventory or equipment subject to rapid technological obsolescence. Think about a smartphone maker or maybe a fast fashion retailer. They have to estimate how quickly their current phone models in inventory or the specialized machinery making them will become worthless due to new technology or rapidly changing consumer trends.
Big risk in tech and fashion.
Huge risk. If they're too optimistic about how long their inventory will hold value, their current balance sheet looks robust. But a sudden market shift, A competitor's breakthrough product, a change in style, could force massive write-downs later, hitting profits hard. Another big one, deferred tax asset valuation allowances. Companies sometimes have tax benefits, like from past operating losses, that they can use to reduce future tax payments. A deferred tax asset represents that potential future benefit.
Okay, an asset based on future tax savings.
Right. However, if management believes it's more likely than not that the company won't generate enough future taxable income to actually utilize all those benefits, they need to create a valuation allowance against that asset, effectively reducing its reported value on the balance sheet. If they underestimate the need for this allowance, maybe they're too optimistic about future profits and then future performance turns out weaker than expected, a large write-off of that deferred tax asset could occur suddenly, surprising investors and hitting net income.
So optimism about future profits has a direct tax asset impact.
Directly. Then there's capitalized computer software costs. This involves estimating how long newly developed or acquired software will be productive and generate revenue. For a software as a service SaaS company, for example, they might capitalize a significant portion of their development costs as an asset. But if their software's useful life turns out to be shorter than they estimated, maybe due to new competition or changing customer needs, they'll face unexpected acceleration of amortization expenses or even significant impairment charges later on.
The useful life estimate is key there.
Absolutely. For banks and lenders, loan valuation allowances are incredibly critical. This is their estimate of how much of their loan portfolio might go bad loans that borrowers ultimately won't be able to repay. It's the allowance for doubtful accounts or provision for credit losses. If a bank is too optimistic here, setting aside too little for potential losses, and then an economic downturn or recession hits, they might face a sudden surge in bad debts. This could require massive, abrupt increases to their loan loss provisions, which directly hammers their reported capital and profitability. I've seen entire financial institutions get into serious trouble because they underestimated this one estimate during good times.
That sounds like a major vulnerability for banks.
It is. Then you have litigation-related obligations. When a company is involved in major lawsuits, estimating the potential cost of a negative settlement or judgment is highly uncertain. A company might set aside or provision a certain amount based on their best guess. But if the case goes poorly, or the judgment is much larger than anticipated, the actual cost could be far higher, potentially wiping out a whole quarter's earnings or more.
Highly unpredictable.
Very. Also, amounts reported for long-term obligations, such as pension post-retirement benefits, which we touched on earlier. The value of these liabilities depends heavily on future assumptions: interest rates, employee life expectancy, healthcare cost trends, salary increases. Small changes in these assumptions, especially the discount rate, can lead to massive swings in the reported liability on the balance sheet, often appearing as a charge or credit to other comprehensive income, or impacting future cash funding requirements.
More estimate sensitivity.
Definitely. And finally, amounts reported in long-term contracts. For industries like construction, aerospace, defense contracting, these projects can span many years. Estimating the percentage of completion accurately, forecasting the total cost to complete the project, and predicting the final revenue can be really challenging. These estimates are often revised as the project progresses, leading to potentially significant adjustments in reported profit from one period to the next. So why does all this matter to you? These are the specific areas where management's judgment calls have the biggest potential impact on the numbers. This means future reported results could look very different from what's currently presented if those judgments turn out wrong. This section effectively signals areas of higher inherent risk and potential volatility in the company's future performance. Reading this carefully helps you understand where the financial statements are, shall we say, softer or more dependent on forecasts. This raises an important related question. How does a company's reliance on just a few key relationships, maybe one big customer or one critical supplier, or its dependence on specific markets, get disclosed, especially if that reliance creates a vulnerability?
That's fascinating because it really forces you to think about how potentially brittle a company's reported financial health might be if some of its key underlying estimates are significantly off. It adds a layer of necessary skepticism. Now, let's move to that last critical area of risk disclosure you just alluded to. Current vulnerability due to certain concentrations. This sounds exactly like the putting all your eggs in one basket scenario.
That's precisely what it is. Vulnerability due to concentrations arises when an entity is exposed to a risk of significant loss that could potentially have been mitigated through greater diversification. It's about that all eggs in one basket situation, where a significant portion of the company's business, its revenue, its supply chain, or its financing relies heavily on a single source or factor. This makes the company disproportionately sensitive to changes or disruptions related to that single factor.
Okay, it's about dependency risk. So, what are the specific criteria that would actually trigger a disclosure here? It sounds like they'd have to be pretty stringent to avoid overwhelming us with every minor dependency a company might have.
They are quite stringent, yes. All three of the following criteria must be met for a concentration risk to require disclosure in the notes. 1. The concentration exists at the financial statement date. This means the vulnerability is current and real now, not just something that might hypothetically happen in the distant future. It's an existing dependency at the time the report is prepared.
Okay, it has to be present tense.
2. The concentration makes the entity vulnerable to the risk of a near-term severe impact. Now, a severe impact means a significant financially disruptive effect on the normal functioning of the entity. We're talking about something serious enough that it could really hurt the company's ability to operate, generate profits, meet its obligations, potentially leading to material losses or even threatening its viability. And near term, again, generally implies within the next year or so.
So, big trouble, potentially soon.
Right. And 3, it is at least reasonably possible that the events that could cause the severe impact will actually occur in the near term. This isn't just a remote one-in-a-million chance. There needs to be a tangible, realistic possibility that the adverse event triggering this severe impact could happen relatively soon. This makes it a current and pressing concern for stakeholders reading the report.
Okay, so it has to be current, potentially devastating, and reasonably likely to happen soon. That makes perfect sense for flagging the most critical dependencies. What are some common examples of these concentrations that companies might have to disclose under these rules?
Common examples are quite illustrative and really highlight tangible business risks you might not think about otherwise. Concentrations in the volume of business transacted with a particular customer, supplier, lender, grantor, or contributor. Imagine a small contract manufacturer, maybe making components for smartphones, and 80% of their revenue comes from one very large tech client like Apple or Samsung.
Highly dependent.
Extremely. If that single client decides to switch suppliers, bring manufacturing in-house, or significantly reduces orders due to their own market shifts, that manufacturing company is in deep trouble, potentially facing bankruptcy very quickly. Similarly, heavy reliance on a single supplier for a critical, perhaps proprietary component could halt a company's entire production line if that supplier faces issues like a natural disaster, a fire, a labor strike, or even geopolitical problems.
Supplier risk is huge, too.
Absolutely. Another example. Concentrations in revenue from particular products, services, or fundraising events. Think of a pharmaceutical company whose fortunes rely almost entirely on a single blockbuster drug. If that drug loses its patent protection and generics flood the market, or if new, more effective competing drugs emerge, or worse, if unexpected severe side effects lead to a regulatory recall, the entire company's revenue stream could be jeopardized almost overnight. For nonprofits, heavy reliance on one major annual fundraising gala can be a huge concentration risk if that event gets canceled or is poorly attended due to unforeseen circumstances.
The single product risk, yeah.
Also, concentrations in the available supply of resources, such as critical materials, labor, or essential services. A large-scale semiconductor manufacturer, for example, might be entirely dependent on a single mine in a specific country for a critical rare earth material needed for their chips. If that source becomes unavailable due to geopolitical tensions, trade wars, export restrictions, or production problems at the mine itself, the company's ability to produce could effectively cease, impacting global supply chains downstream. Or consider a specialized consulting firm, heavily dependent on a small pool of uniquely skilled experts who would be very difficult to replace quickly if they left.
Resource dependency.
Right. And finally, concentrations in a specific market or geographic area. Think of a regional bank that only operates in one state, perhaps a state heavily reliant on a single industry like oil and gas. If that industry experiences a severe downturn or the state suffers a major natural disaster like a hurricane or earthquake, that bank's loan portfolio and overall business could be highly vulnerable. Or maybe a real estate developer focused only on luxury condos in one specific, highly competitive urban market concentration. They're very exposed to local market conditions. So why does this matter to you? This section on concentrations highlights specific identifiable risks that could severely impact the company's near-term future, maybe even its survival. It helps you assess the company's resilience. How well can it actually withstand shocks if one of these major dependencies goes south? It's a critical gauge of the company's stability, revealing hidden fragilities that a more diversified company might not face to the same degree. It tells you where they might be most vulnerable.
This has been an absolutely eye-opening deep dive. When we started, these notes to financial statements might have seemed like, I don't know, just legalistic fluff, maybe something technical to skim over quickly.
Yeah, many people do.
But what we've seen today is that they are an absolute treasure trove of vital, granular information for anyone who wants to truly understand a company's financial health, its operations, its underlying policies, its risks, and its potential vulnerabilities. Hopefully, you listening now feel like you have the tools, the insights, and the understanding to look beyond just the top line numbers on the income statement or balance sheet and really dig into the intricate details that truly tell a company's full story.
That's exactly right. And if we connect this to the bigger picture, the knowledge you gain from carefully examining these notes allows for far more informed decision-making, whether you're investing, lending, partnering, or even working for a company. It also cultivates, I think, a deeper appreciation for the complexities involved in financial reporting and the significant judgments that go into preparing those statements. It's not just black and white numbers. Understanding these notes equips you with critical thinking skills that actually extend far beyond just finance. They help you evaluate any complex information set with a more discerning eye, constantly questioning assumptions and seeking the underlying truths or potential biases.
Well said. So, as you go forward, whether you're looking at a company's quarterly or annual report, maybe preparing for a business meeting, or just satisfying that insatiable curiosity about how things work, here's a final thought provoking question for you, the listener, to consider. Given how much of financial reporting relies on management's estimates, those informed guesses, and the required disclosure of critical concentrations and other risks, how might your understanding of a company change? How might your assessment of its strength or weakness be different if you always made a point to seek out these specific details in the notes before making any judgments about its overall financial health? We definitely encourage you to seek out those notes. Thank you so much for joining us on this deep dive. We hope you've enjoyed the journey into the notes as much as we have. We look forward to diving deep with you again very soon.